here with Jan Loeys, who is Global Strategist at JP Morgan. Jan, global strategy at the moment is keeping you a bit busy, I would guess.
Absolutely.
Well, how is the asset management industry coping with these very volatile markets?
In a difficult fashion, I'd say. The problem is that the product of which asset managers make most money are equities. And equities clearly are not doing well. We had a nice recovery last year. We're already down on the year, and institutional investors are very wary of the asset class and trying to move away from equities more into the fixed income world, so that where the fees are much lower.
And do you think going forward we'll see any sign of sustained recovery in equities? Or?
Well, there is some sign in the sense of the alternative to equities is quite bad. I mean, if you don't do equities, I feel a lot of investors have to be in cash, and cash gives you no return. If you go into safe government bonds, treasuries, bonds, you get barely any return. You get 2% handles. So the investor community clearly needs to go elsewhere. The bullish factor, the bullish force for risky assets, including equities, is that the alternative is bad, meaning cash and governments are low in yield, so you have a very strong value force helping you with risky assets. Risk premium are wide, but there's a reason for it. So, risks are high too.
Yeah, and so how can the asset manager find value but not engage in risk in these markets?
That's impossible. You get paid for taking risk, and so you, as an asset manager, you need to go for the asset classes where investors are interested in, and they're clearly a lot more interested in emerging, and they're interested in fixed income. So you need to combine those. So you combine and buy, make it emerging fixed income.
Okay.
And, that's where the interest is. And there's good growth over there too, and good fundamentals. Emerging countries don't have the same debt load that the developed markets are having. So when you do local government debt, or the corporate debt, either traded in dollars and euros or in local currency, that's where the new demand is for. And importantly, this is clearly an asset class you cannot do passively. ETFs are not going to be doing too well, so very actively managed, either hedge funds or actively managed emerging market fixed income, which you can do currencies, you can do bonds, credit, external, local. There's a lot of upside for active managers over there, and that's where the fees are going to be much better.
Okay, and what about trends going forward? Have you picked up, I mean, particularly being here at FundForum, have you picked up any trends that
well, there's clearly
new ones?
I think international investors need lower costs, and that's particularly an issue in Europe, much less in the US, where the cost structure is already much lower. So Europe needs to very quickly consolidate. We got way too many products, way too many players. By consolidation, we can get economies of scale, we can get the cost structure down. I think that's the first priority to have.
Thank you very much, Jan Loeys. Thank you for your time.
Thank you.